Welcome, I'm Catherine Magana here with Steve Wolf, Greg Carroll, and Vince Stefano, where we're here to provide you some insights about the markets and investing. Steve and I were in Chicago last week visiting with clients, but that didn't mean we didn't hear the news about the interest rate changes and the markets were up last week. But as we go back now this week, a week later, and reflect, the markets really haven't moved too much since last week. Last week, obviously, we saw a big run up in the stock market. But as I was reflecting from last week to this week, the Dow Jones is pretty much flat. The S&P 500 is pretty much flat. The only one that's moved a little bit is the Russell 2000, which is more small caps. That's actually down a little bit from last week. And we're seeing right now talks about, is there still going to be another interest rate cut this year? There's talks about a 25 basis points cut potentially between now and the end of the year.
Well, I'm not really surprised that the market didn't move a lot because this is pretty well known that they were going to do it. So pretty much the news was already in the market. So not a big surprise.
Well, the day that I got cut, the market moved pretty up a lot that day. But since that point till now, in the last 7 days, it's pretty much been flat.
Yeah, and I think part of that is the volatility that we've talked about, because of what's happening in the market. And a few days ago, some pundits came on some of the news shows, and they were talking about a warning about a deterioration of financial conditions in the United States, and they were, issuing, red flag warnings for, the death knell for mega cap tech stocks. They were saying valuations were too high and that AI spending was now slowing. In fact, one talking head actually said that investors in tech stocks are currently whistling past the graveyard. So what happens? Well, a couple days ago, China comes out and hits their economy with massive amounts of capital infusion because they want to get to their yearly growth rate. U.S. second quarter GDP goes up 3%, and the result, we had a nice market rally today. And what's leading the market? Technology stocks. Yes, indeed. So where are we now? I think between now and...
So are you saying that we really shouldn't listen to the stuff we hear on TV?
I think, those guys are like broken clocks. but I think that, we're going to stay volatile through probably mid-November. And, I've got a couple of reasons. Number one, we're still in September, and that's always difficult for equities. Number two, we've got the ghosts of October, that are on the horizon. We've got Mideast, which is still escalating, and we don't know what's going to happen there. And we have the presidential election, which I believe is most important, since many, many people have asked me, hey, what do you think? What do you think? And I tell them, hey, listen, the market is a forecasting entity. And usually by this time in an election cycle, the market kind of knows who may win the presidential election. I said, but this year, I don't think the market has a clue. And they go, what should you do? And I said, well, my suggestion to them and to all investors, number one, stay invested, high quality stocks that have very high unit volume growth rates. That way you will continue to get the escalation you need from when the market does turn and moves to the upside.
I was kind of enjoying this because you have kind of a Halloween theme coming into October. You're whistling past the graveyard. You had the ghosts of October past. All we're missing is who was Jacob Marley? Oh, that's Christmas. Yeah, but you're right. But October has been a month. Everyone thinks October is the bad month because October is the one that's had the most dramatic things happen. But October, November, December, generally speaking, have been good. On the other hand, September usually is bad, and this year September was pretty good. So who knows what's going to happen? I will say this, and I kind of was kidding about it before. I think the best thing that people can do is turn off the TV. Stop looking at newspapers or whatever, and stop listening to the radio as far as predictions are concerned. Because for every prediction that you hear, I can find another one that says the opposite.
Yeah. Well, it's interesting. I've had a lot of conversations in this last week, once again, about the presidential election and should I be doing anything differently. And as I look back on history, the S&P 500 index returns from 1928 to 2016 elections. There have been 23 elections, and during that time, 19 of the 23 years, 83% have had positive performances. So election years tend to be positive. Doesn't matter which side of the fence you're on, but just interesting. We're not trying to time the market and jumping in and out. We have a long-term perspective and view, and that's why we have a financial plan in place. And not even just elections, but in general, there's always something that's happening in the world. There's a crisis, there's an event. And yes, we're mindful of that, but we're not reactive to those types of situations. We have a really long-term perspective, and along the way, we might make some subtle changes, but we're not jumping in and out of the markets. I actually also found Liz Ann Saunders, who's the chief investment strategist for Charles Schwab, posted yesterday, September 25th, that the U.S. large cap equities actually had an inflow last week of about $23 billion, whereas government bonds saw an outflow, and that was for exchange traded funds. So as we're seeing interest rates change a little bit, people are still putting money into equities, and even as I'm looking at some of the short-term rates, money markets, CDs, everything's coming down. Those rates are definitely getting hit, and especially if we think there's going to be more interest rate cuts coming our way.
The funny part though is that I think bonds actually are in a good spot because if interest rates continue to come down, price on bonds is going to go up. So it's kind of interesting that people are taking their money out of bonds and putting them into stocks. Now, obviously, lower rates is good for the economy. So I kind of understand that, but I wouldn't be afraid of the bond market right now.
What's interesting is after they lowered the rates last week, longer-term bond interest rates actually went up over the last 7 days. The 10-year, I believe, is over 380 today. I think it was about 350, 360 last week. So, it's kind of like buy the rumor, sell the news type of a thing, right? And that's when all the money was leaving the bond market ETFs, the interest rates start going up because they work inversely. So, I also did a little bit of reading on the election and more specifically about this one. Voya has their economists and portfolio managers and talking about a lot of different areas and, what areas of the market might be a beneficiary of a Trump administration compared to a Harris administration. And Trump beneficiaries, sectors of the market would be energy, finance, Medicare Advantage, and crypto. A lot of that has to do with deregulation, in the energy fields. He wants to pump more oil, so they would deregulate some of that. Finances, and he really wants to privatize the over 65 healthcare system. So that's where the Medicare Advantage comes in. Crypto, I don't know what his angle is there, but apparently he likes crypto. So how maybe deregulating some of that.
He
too.
just bought some crypto apparently that was pretty well publicized.
Oh, okay.
Paid for a hamburger via crypto.
And then some of the areas that Harris administration might benefit would be renewable energy. Obviously, they're really pro renewable energy. I don't think that is enough of, I don't think they can produce enough renewable energy to meet all the demand that we're seeing from data centers and everything. So I do think they need to open up to some new areas there. Home builders, they have a big tax credit, or she's talking about a big tax credit for home builders or first-time buyers. Staples, and maybe even international equities. Internationals, they say, might do a little bit better, relatively speaking, because the Harris administration might not be as hard on the tariffs. Although the Biden administration didn't like tariffs after Trump, but I don't think they got rid of any of the tariffs, did they?
No, they didn't.
Yeah.
Matter of fact, they actually added onto it. So
they did add something.
It's a weird. Look, I'm personally against tariffs. I don't like when countries do that. But here we are, and we're doing it, whether it's the Trump administration or Biden.
Yeah, I remember back in high school reading about tariffs and how bad they were. And yet here we are, and we're talking about adding more.
And when were you in high school?
And that was a long time ago. Anyway.
That was a
Speaking
long
of high school, I don't know if we were in Chicago last week. I saw Steve's childhood home and area he grew up in Lincolnwood. It was actually kind of neat to see where he grew
and it's
up.
hard for me to believe. We went to Chicago. We were there for 4 or 5 days, and we did not have one deep dish pizza.
Or a Chicago hot dog.
We didn't have a Chicago hot dog. We didn't have an Italian beef sandwich.
You went to Portillo's, though, didn't you?
No,
did
we
not.
didn't. We didn't.
What?
We were
No,
busy.
we were so busy talking to clients that we just didn't have time. It was incredible.
But we did make it to a Cubs game with a client, which was nice. That was a
there
lot
you
of
go.
fun. Even though they didn't win, but that's okay. It was still fun.
Yeah, but we didn't care because right now we're rooting for the Padres.
That is
Everybody's a Padre fan.
At least here in San Diego.
We're all fair weather fans here. It's like, go Padres.
Who?
By the way, I once again looked at the CNN Fear and Greed Index. And of course, we're now up to almost extreme greed. We're in the greed section at 72 points out of 100, which I thought was kind of interesting. You know, that with all the news that we hear about, and so much of it is negative, that people are still wanting to put the money in the stock market. And I guess the inflows of what you just talked about before into the equity funds kind of corroborates that.
Yeah, especially in the last week. I think when things started to stabilize a little bit, then everyone started shifting a little bit.
Yeah, as soon as rates came down,
Yeah,
everybody
right.
wanted to jump into, because everybody knows that lower rates are good for stocks. And, and I've said all along, I think investors continue to have to focus on really high quality growth names. Those are going to be the drivers for the next 18 to 24 months, no matter what people say about utilities and all the other kind of value-oriented, low valuation stocks. They will have a bit of a move, but they're not going to have the accelerated moves that people want to generate the outsized return. So stay in good growth stocks. Find really good companies, good products, good balance sheets. That's where I'm staying.
Well, the utilities have already had a big run.
They have. Yeah.
I know I have one utility, and I won't say which one it is, but it was at about $90 a share maybe 2-3 months ago, and now it's about 115. That's a pretty good move. So I think a lot of that is already in the market. People are anticipating, as they normally do, because what you said is the market is a forward-looking instrument. So that's probably already in the market. I wouldn't discount the value stocks, though. I mean, they have underperformed for so long, and the relative value of them versus some of the growth stocks are still pretty good. So I wouldn't just discount them. But what you said, too, about being in high-quality stocks, I think you should always be in high-quality stocks. And then you don't really have to worry about, for the most part, what's going to happen with the election or what's going to happen with any of the other things that we seem to worry about on a day-to-day basis.
Well, I think what I was trying to tell most of the investors that listen is don't try to jump between asset classes of stocks. Stay with very good companies all the time, because that's where you'll do best.
Long-term approach. One of the things that Voya study went into was looking at different asset classes or different areas of the market. 12 months before the election and 12 months after. And one consistent theme during that 24 months is large value. I'm sorry, value and small.
Oh.
In what
Small
way?
cap.
What do you mean?
They outperform relatively compared to value over growth, small better than large.
Right.
So, looking at, I think people maybe like the stability, and a lot of value stocks pay a little more coupons possibly, but a lot of people are uncertain coming into most elections, and they don't want to be taking a lot of risk, and maybe that's why some of the money has come out of some of these higher growth names that have done extremely
The other thing is, how do you define value? I know value guys that buy Apple, Amazon, Google, and they say, hey, those are value stocks.
Or they can be core positions, or their growth and value.
Yeah.
Well, I'm talking more like the Procter & Gamble's, the Coca-Colas, which have had a move.
Yeah.
They've moved a little bit here in the last 3-4 months. So that's right. But you know what? When you talk about whoever it was on TV.
I can't remember who said that.
Who was saying, the bad things about AI and stuff. We are just in the beginning of this.
Yeah.
Okay.
Oh, yeah.
And it's true that some of the stocks probably moved a little bit too fast. But my guess, for what it's worth, is that over the next 10 years, AI, they're going to spend humongous amounts of money on AI because they have to. There's big companies, and then even the small companies. Every company is going to have to use AI in order to compete.
And the utilities are going to continue to do fairly well because they have to do a lot of build out of their infrastructure to produce all that power for AI.
And it looks like we're starting to move back toward nuclear, which is interesting. I think it was, 3 Mile Island or whatever it's called. They're talking about engaging
Microsoft
it.
already has purchased the rights to fire that baby back up.
Correct. And there are companies out there right now which are taking the nuclear energy and making small nuclear reactors, if you will. I know there's a company out there that's using the waste products from nuclear, and it's still I'll say it's not so much experimental, but they're actually getting out there right now and seeing how good this works, or how well this works. my guess is that by 2026, they could be on the market. And I'll think about that for a minute. That's been the big bugaboo, is that the waste, what are we going to do with it? Here's a company that's come up with some way to use the waste to make nuclear energy. So I think that that whole area of AI, energy, whatever, is going to be very good for the next 8-10 years. So in my opinion, this is strictly my opinion, anytime there's a pretty big downward move, put some money in there if you have it. How's that for exact advice? I won't tell you what companies, because then I get my head chopped off by
the dips,
our compliance department, but definitely buy the dips in that.
Yeah.
So nothing else for this week. Then next week will be October, right?
Yes, fourth quarter.
Fourth quarter's coming up, and hopefully that will be good, but we'll let you know what happened this week next week. Thanks a lot for listening.
Thank you.
Bye.
Please stay tuned for important regulatory disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Wolf Wiese Magana, LLC, doing business as WWM Financial, Savvy Doc Financial Planners, and Savvy Woman Wealth Management, is a registered investment advisor with the SEC.